SoftBank once seemed unstoppable. Its founder, Masayoshi Son, became legendary for bold bets that turned tiny startups into global giants. But one of his most ambitious wagers, a massive tech investment strategy built around the Vision Fund, didn't just wobble, it almost crashed the whole company. In this video, we'll break down how SoftBank's $200 billion tech gamble unfolded, how it almost bankrupted the Japanese giant, and how the company survived to fight another day. The Vision Fund, a bet unlike any other. In 2017, SoftBank launched the Vision Fund, a venture capital arm that would go down in history for its size and ambition. It wasn't funded from SoftBank alone. Saudi Arabia's public investment fund and other partners committed massive capital, creating what was effectively the biggest startup investment vehicle ever assembled. The goal was audacious: pour tens of billions into the next wave of technology companies, especially in areas like AI, cloud computing, robotics, and marketplaces. This wasn't traditional investing. SoftBank wanted to accelerate entire industries, backing startups with enormous capital at unprecedented valuations. The idea was that these companies would grow fast and dominate their sectors, and SoftBank would profit massively when they did. On paper, the strategy made Silicon Valley look small-time. Analysts described it as an all-in bet on technology's future. But what was exciting on stage quickly became terrifying in the boardroom. The flaws start to emerge. At first, everything looked great. Vision Fund invested huge sums into high-profile companies that had potential to transform entire industries. But many of those bets were on business models that did not yet make money. Tech isn't supposed to be profitable at early stages, but betting hundreds of millions on companies that are years from profitability adds enormous risk. The strategy was based on three assumptions. Startups would grow into monopolies or near monopolies in their markets. Capital markets would keep valuing growth over profits, and SoftBank could hold stakes long enough to profit from exit events or IPOs. When those assumptions held, SoftBank made money. When they didn't, things turned ugly. The WeWork collapse, the turning point. One of Vision Fund's most notable risks was with WeWork, the contentious office-sharing firm. SoftBank invested billions in WeWork, valuing it near $50 billion at its peak. Investors saw WeWork's enormous losses, poor governance, and struggling business model before the pandemic when it went public. The public offering was quickly canceled, WeWork's valuation plummeted, and SoftBank took the hits. This one investment alone might have cost tens of billions, and the impact went beyond that portfolio business. According to estimates, SoftBank experienced large equity losses and had to write down most of its investment value. WeWork became synonymous with the Vision Fund's failed big bet strategy. SoftBank has been criticized for encouraging a growth-at-all-costs mindset in tech businesses, leading to bubble-like prices. Valley-wide losses and market reality check. WeWork was not alone. As global interest rates increased and investors prioritized profitability, tech valuations plummeted. Vision Fund portfolio companies, including ride-hailing and financial startups, experienced significant value decline. SoftBank lost money on DD and AutoStore due to valuation reductions. Vision Fund investment losses of hundreds of billions of yen caused SoftBank to declare quarterly and annual losses that surprised the market. SoftBank recorded a surprising financial loss of 369 billion yen, about $2.4 billion in one quarter, due to a steep drop in Vision Fund values. These losses were large. They caused SoftBank to rethink its funding infrastructure and future tech investments. A company known for its aggressiveness was suddenly condemned for irresponsibility. When the bet became personal. SoftBank founder and CEO Masayoshi Son makes bold bets. However, the Vision Fund downturn affected his personal fortunes. Son once owed billions of dollars due to SoftBank stock and pay arrangements. This questioned corporate governance and how closely Son's wealth was tied to the company's success. As losses increased, personal risk and business strategy put SoftBank under pressure. Son's reputation and personal future were at stake, as well as the company's. From near bankruptcy to strategic redirection. Vision Fund losses hurt SoftBank's financials, not just hearts. The company had to sell or write off large amounts of assets, including holdings in key companies, due to cash flow issues. SoftBank's large Alibaba holdings were once valuable. SoftBank had to use such holdings to obtain funds to cover operating losses and fund new aspirations when tech market valuations fell. The near $200 billion invested to Vision Fund vehicles became both a symbol of ambition and a catastrophic financial burden. SoftBank, once Japan's most profitable technology conglomerate, lost money for years. Critics called SoftBank's strategy like a ship captained into a storm without a map, and it looked like it might fail. How SoftBank survived. Despite challenges, SoftBank survived. It changed direction and survived. It sold assets, cut costs, and shifted its focus from startups to AI and infrastructure companies with higher returns. SoftBank reported in 2025 that it would prioritize AI and critical infrastructure investments, including generative AI and data center expansion. This shift means the Vision Fund is moving away from scattergun startup bets and towards strategic initiatives. In 2025, SoftBank invested billions in AI infrastructure and startups, reorganizing its investment teams to align with its new goal. What went wrong and what went right? There were several key structural problems in the Vision Fund's $200 billion experiment. 1. Betting too big, too fast. SoftBank invested enormous sums into highly speculative companies. In a low-interest rate era, that looked smart. Once market conditions changed, however, the weaknesses were exposed. 2. Lack of profit focus. Many investments prioritized growth at all costs without viable paths to profitability, making them vulnerable when valuations corrected sharply. 3. Hubris and overconfidence. SoftBank's approach was based on the belief that capital alone could create winners. In reality, many companies needed better fundamentals. But there were positives too. SoftBank produced real success stories, the most famous story being Alibaba, whose early investment paid massive returns and financed much of SoftBank's future ambitions. And even in the Vision Fund era, some investments in companies like ByteDance eventually delivered gains. The legacy of the Vision Fund era. Today, the Vision Fund is capacity constrained compared to its early years. SoftBank has written down a lot of assets, scaled back investment frequency, and refocused on strategic bets in AI and hardware infrastructure. But the Vision Fund era remains one of the most important chapters in global venture capital. It pushed private market valuations higher across tech industries, changed how startups think about capital, and then illuminated the risks of too much capital chasing returns without profits. For SoftBank, the Vision Fund's near-bankruptcy moment was both a humbling experience and a school of hard lessons about risk, timing, and the difference between bold vision and reckless capital deployment. SoftBank's $200 billion gamble almost toppled one of the world's most ambitious tech investors. But out of near bankruptcy came lessons, strategy, and a renewed focus on shaping the future of technology. Masayoshi Son's Vision Fund era may have been a roller coaster, but it proved that in the world of tech, bold bets can bring both spectacular gains and humbling losses. The question now is, will SoftBank's next chapter in AI and strategic tech investments finally deliver the massive wins it dreamed of, or will history repeat itself? If you enjoyed this deep dive, make sure to like, subscribe, and comment below. Which SoftBank investment do you think will define the next decade?